Hello everybody, we are Adam Carlini, this is Grant Haddon, I am Gary Luna, and we are Dynamic Wealth Management. Welcome to Monday, October 19th. This is our market update edition. We will talk about what happened this past week with the economy a little bit, the stock market, and even give you a comparison between this year and prior years that are key years and what's going on. Great weather, Grant, here in Arizona.
Yeah.
In fact, 81-degree high, so if you are not here, we welcome you here. Would love to see you in the coming months.
Yeah, we're excited to do this video today. If you saw our last video, then you know that we've had a couple of good weeks in the stock market. Those weeks have pushed us into a green zone. We were hesitant to do that and become a little more aggressive in our client accounts, but we did. It paid off this last week, so we'll jump into things and talk about where we're going to be allocated this upcoming week.
All right, thank you for being with us this morning. We'll start with some upcoming events that we have. So tomorrow morning, October 20th at 9 o'clock a.m., this is a Tuesday, we have an Investments for Breakfast meeting here at our office in our conference room. We'll have a little breakfast there for you. We'll talk in depth about the markets and where things are now, more than we can in this short video. Also, for those of you who are out in Sun City Festival area, we'll be out there Thursday morning, October 22nd, 9 o'clock a.m. as well. And again, we'll have some breakfast and go over the markets. And then lastly, we do have a seminar in Sun City Grand. That's Tuesday, October 27th. We'll be out there at 5 o'clock. Please RSVP, give us a call if you can make any of those events. We'd love to see you. As we previously stated, our risk indicator is still in the green zone. We were pretty hesitant about that last week, but actually we made our moves on Monday and we changed from a yellow allocation to a green allocation, becoming more aggressive, and that did pay off for us. Luckily, it was a good week in the market and we made a little bit of money. So hopefully we'd love to see that going forward, but as Gary will point out when he starts here in a minute, we expect some volatility going forward, and we're probably not out of the woods yet, but we are happy to see the market moving our way. A couple key economic events here. The first one is the Consumer Price Index. This came in a little weak. You can see here it's at 1.9%. The Fed likes to see it at 2%. And previously we had a slide here, a month-to-month change of down 0.2%. So that is bad news, but what that means is that the Fed will probably not raise rates before the end of the year. This was probably more evidence to them that the economy is weak and they will not raise rates. And so generally, the market has liked that as of late. Continuing on to the industrial production as well, more bad news. Also down 0.2 over the last month. This one's been sliding since December of 2014 and just kept going down. So as we continue to get more weak reports and more bad news, generally the sentiment has been that bad news is good news. It's backwards that way, that as we get bad news, people view that the Fed will hold off, and actually we should see the market rally off of that. So I'll let Gary give us a stock market update.
Great, thank you, Grant. As always, we will go ahead and start off things with the S&P 500. Remember, the chart you're looking at is a 6-month chart, and this is a candlestick chart, so every one of these marks is a day in time. And so what we're looking at is the last 5 or 6 marks or candlesticks. So you'll remember that last week we broke through resistance here, and we started off the week with a couple down days. The good news is we tested support at about the 1995 level, and the good news is we broke and we held. We bounced, in fact, nicely on Thursday. Friday we held, and today a little bit of a down day, which is to be expected as the market is now trying to make its move on the key 200-day moving average, which is right above us at this point. If we do break above that, the next level would be 2052, which represents the lows of July and August. So we'll see what the market does, or does it come back down and test these levels? Obviously, we'll let the market dictate, but we hope that we continue to rise and move forward. One of the things we did this past week is we tried to compare and tried to set expectations for our clients as to what type of market we are looking at. And so what we did was we compare here 2015, which is the green line, to a 2011 S&P to a 2007 S&P, which represents the blue line. And that gives us some idea as to where we might go. And what we learned is two key things. One is that you'll notice we are right here as we compare the different time frames for those three periods and what the market might look like. And one of the things that we find is that from where we are now, we might expect another couple, 2 or 3 months before we actually get full clarity as to the question, is this just a correction where the market breaks down only to rise again for the next leg of the bull market? Or is this a counter trend like we had in 2007 where the market broke down, rose, only to break down again into a full-blown bear market? For now, as you can see, it looks more like 2011, but the market will dictate. So first order of the day, or one of the things we learn, is to be a little bit patient, as we obviously might see more uncertainty in the weeks and months to come. Also, expect more volatility, as you see here by the percentage breakdowns and counter trends and rising back up. Even in the bear market, which was a 57% drop, lasted 17 months. Look at this counter trend of 15% upwards. So how do we handle that uncertainty and that type of volatility? Well, in our model allocation, one of the key things that we look at is we compare stocks to cash as our main indicator on a weekly basis. And as Grant mentioned, we did break above key moving averages, and we are, for the second week, still in a green bullish zone. So we will let the market dictate to us and not allow prediction or bias to cloud our judgment, and we'll let the market dictate what is a necessary and prudent allocation. As you can see here, there is the percentages and the comparison between risky assets and defensive assets across our different client risk tolerance profiles. If you have more questions on that, please give us a call if this is all brand new to you, or if you are not a client and want more information. As always, none of what we have talked about here in this video is a solicitation to buy or sell any specific investment or index. And this pretty much concludes this weekly update as of October 19th, 2015. And we look forward to talking to you again in the weeks to come. Have a great week.